Hello everyone, we'll get started in a second. There we go. So, welcome everybody to today's session. We will be talking about, should you lock in a 10-year mortgage right now or not? Because you might have noticed that, mortgage rates have been dropping steadily lately. So, the key question is really, should you actually lock in right now? Well, before we can answer that question properly, we really have to look at how do you actually, what are the numbers that kind of feature in this entire story, right? So, for instance, how much more expensive is a 10-year mortgage compared to a 5-year mortgage? Should you get a variable one? Should you get a fixed one? What are the pros and cons of all of those? So I've covered some of this stuff in previous sessions, but just a very, very quick and brief review. So let's have a look. So what are the different types? Let me just, there we go. Okay, I'm just checking that there's no feedback. Excellent. So what are the different types of mortgages? So great question. So first of all, there are two different subtypes. There are floating rate mortgages, and then there are fixed rate mortgages. The floating rate mortgages, there are actually two subvariants. The fixed rate mortgage, within the floating rate mortgage, there are these two subvariants. So, subvariant number one is the adjustable rate mortgage, and the other one is the variable rate mortgage. And then there's different hybrid models where a portion of your mortgage might be fixed, a portion might be variable, and so on and so forth. Right. So the really important part of understanding how floating rate mortgages work is that basically they're influenced, or the rates are set pretty much by whatever the Bank of Canada overnight prime rate is set to be. So the overnight rate, so again, all of these, I'm just gonna copy this to you right there. They should already be in, yes, I think I have updated the descriptions there. They should be in the description already, but basically here's the link to this the first section here, this first page. And this is what it looks like, all right? So you can see here, if you're looking at the historic data, obviously we were at relatively low interest rates compared, if you're looking at in a kind of in a historic perspective. But obviously with COVID-19 hitting, there have been three rate reductions of 0.5% apiece. So we went from an overnight rate of 1.75 back in basically January, February, to right now 0.25%. Now that's the overnight rate that the Bank of Canada sets. That's also called the policy interest rate. Now on top of that, there's obviously other surcharges, if you will, whenever you're getting a mortgage from a bank. You currently cannot go to a Canadian bank and get a mortgage for 0.25%. That's just not a thing yet, right? So banks basically look at this alternative, and whenever these rates go high, that's also when they will increase their floating rate mortgages. So as I said before, there's these two subtypes: the adjustable rate mortgages as well as the variable rate mortgages. So they're very, very similar. The only difference really here is that an adjustable rate mortgage, pretty much whenever the Bank of Canada increases its rate, you're pretty much, whenever your next mortgage payment is due, your mortgage rate will increase, and the amount that you have to pay will increase pretty much literally the very next payment schedule, whether that payment schedule happens next week or a month from now, all right? So these will be impacted pretty much as soon as the Bank of Canada increases their overnight rate. Variable rate mortgages are also determined by the overnight rate. However, so let's say in this case here, let's say you're paying, I don't know, like you're paying, let me just pick it, I guess it's a more realistic number. Let's say you're paying $2,000 per month, right? And the overnight rate increases by a certain percentage. With your adjustable rate mortgage, literally next payment schedule, next time you have to make a mortgage payment, it might go up to $2,100 or something like that, okay, per month. That's pretty much how it works. So I'll show you on the next slide exactly how the calculation works out. So that, and I'll share resources with you so you can actually run the numbers for yourself, right? Now for the variable rate mortgage, these ones they work very similarly in terms of they're also impacted by the overnight rate, but their main purpose is to attempt to maintain that $2,000 a month payment, if that's your mortgage payment. And instead of increasing your payment by, let's say, $100 in my fictitious example here per month, is they would try to extend your amortization. So in many ways, if you've taken advantage of the mortgage deferral, or you've applied for the mortgage deferral program right now because of COVID-19, in many ways, they've used, the CMHC has instructed banks to use a similar approach to your mortgage. So basically, you didn't have to pay any, you didn't have to make any mortgage payments for 6 months until the end of September, basically. But your amortization will get extended by those 6 months of mortgage payments. They're not gifts. It's not, let's say you owed $2,000 a month over 6 months. So they're not just gifting you those $12K. You still owe it to them. But instead of putting that and increasing, let's say you still have 20 years or 24 years, let's say. So instead of dividing that by 24 years plus interest calculations on top of that, based on whatever your interest rate is, instead of saying, okay, now your monthly payments are going to go up, they just said, well, all right, can we extend your amortization? Can we just make it 6 months longer? Now, variable rate mortgages can literally just extend your amortization, provided that the bank has not lent you more than 95% of the value of your mortgage, and currently you have at least 5% equity in your home, right? Because banks in Canada cannot lend you out more than 95% of the value of your home in the form of a mortgage, and that's if it's under $500,000 for a principal residence, not for a commercial one, not for investment property, not for a cottage. I've talked about this in previous sessions, but just very quick review here. And this 5% is really, that's the minimum equity that you need. So that's how much your down payment plus the current value of the house, whatnot, whatever happened to its value, whether prices have gone up or down, whatever it has to be worth at least 5%. For them to be able to extend it, they can extend it as long as it doesn't mess around with the 25-year max amortization and this 5% down payment. So if the value has dropped significantly, or if you literally just got a mortgage last month, for instance, then they will only be able to extend it by an extra month in terms of payments. So then if interest rates do go up significantly or what have you, they wouldn't be able to just extend it indefinitely, right? And at that point in time, when you're running out of extension period, a variable rate mortgage becomes or behaves very much like an adjustable rate mortgage in that your monthly payments will go up pretty much during your next payment cycle, whenever your amortization has been maxed out again to 25 years and your down payment is at least valued at 5%. All right. So now for a fixed rate mortgage, that one's actually not impacted in terms of how much you actually have to pay for a fixed rate mortgage. That is not impacted by this overnight rate set by the Bank of Canada. Instead, that is impacted by whatever the bond yield is on the Government of Canada bonds that have the same maturity as the a fixed mortgage term. Right? So I know there's a whole bunch of jargon over there. But it's really, really incredibly simple to understand. So all you have to know really is fixed rate mortgages will have different terms for how long those terms and conditions are good for. In certain countries, such as the US, you can literally get a 25-year or 30-year amortization. So that means you're going to be paying back this mortgage over 25 or 30 years with a 25 or 30-year mortgage term. In other words, if you're taking a fixed 30-year mortgage in the US, where you can have one, you will never ever have to pay a different amount than that current amount that you've agreed to, unless you want to renegotiate and refinance and get a new mortgage because interest rates have dropped significantly and you don't mind paying a slight penalty to get the even lower rate in the meantime, right? But yeah, so these fixed rates are in all in all for the kind of majority of Canadians, are usually preferred because it sort of gives you a more easily calculatable, and you have a better idea basically what's going to happen in the future, and you have a better idea of what your payments will be. Now in Canada, the longest fixed rate term that you can get is 10 years. The vast majority of Canadians that have a mortgage tend to have a fixed 5-year term. That's the most popular one. It's fixed, specifically the 5-year fixed. Now this little table here is a few years old, but it's not that different from 2019 numbers. I was looking for more recent data. I couldn't find the proper table just in time for today, but anyway, so this gives you a pretty good idea. The percentages might have gone up or down about 1% in each one of these categories. So there's no massive differences in the last 4 years that have arisen. So you can see here that out of all mortgages, about 68% of people of Canadians have a fixed rate mortgage, and an overwhelming majority of those, about 85-ish% of those 68% have a 5-year fixed. Then 25% have a variable or adjustable one. Right now, I believe it's around 27%. As I said, a couple of percentages have shifted here over the last 4 years, but it's not a massive difference. And then about 6% of individuals have a combination. In other words, they might have, let's say you have a $500,000 mortgage, you might take $200,000 fixed and $300,000 variable, just because it makes more sense from a financial point of view, because one might give you a slightly or significantly lower rate. Now, this was the case a couple of years ago. These days, as I will show you on the very next slide, the rates are very, very similar for many of these. So in many cases, there's no real difference whether you're getting a fixed or a variable rate mortgage in terms of how much you actually have to pay. So specifically, what are the current mortgage rates? Now I'm using, so this is the third link in the description. I'm basically using ratehub.ca. I'm using their website, and here's the link to that again in the chat as well, in case you're curious. So this is a pretty decent website. They're not paying me to tell you any of this. Obviously, make sure to select the correct city that you're actually in, just because different mortgages are only available in certain provinces, so you might get a slightly higher or slightly lower rate based on where you're currently located. Okay. So here you can play around with various fixed rates, and you notice the fixed rate, the longest fixed term you can get for a mortgage in Canada is 10 years. That's the absolute longest one. The most popular one is the 5-year, but there are some people getting 3 years and 2 years and 1 year sometimes. And you can also find sometimes some banks might have some 7-year and other terms as well, but those are far less common. Again, the most common one is the 5-year one. Then there's some 10 years and some slightly shorter mortgage terms as well for the fixed ones. And then for the variable ones, again, this particular website just has a list of the 3 and the 5, but you can get them for 1 year, you can get them for 2 years, etc. But those are the most common ones. So let's have a look at this 3-year variable rate mortgage. Now keep in mind, this is and by the way, the prime interest rate. So keep in mind, the Bank of Canada rate, right, is 0.25%, that overnight rate. Now on top of that, the regular banks typically charge an additional 2% or so on top of whatever the Bank of Canada rate is. So if the Bank of Canada rate is 3%, banks will give out mortgages around 5-ish% or thereabouts. Currently, it's 0.25%. The prime rate, so obviously if you have a decent credit score, if you're a good customer, the prime rate currently is 2.45%. So anything you get at 2.45%, that's prime. Anything you get above 2.45%, you'll see it'll tell you prime plus whatever that is. So let's say if you're qualifying for a mortgage of 2.6%, you're literally getting prime plus 0.15%, right? That gives you 2.60%, right? So this is just to let you know roughly what prime is. Now, prime is calculated again typically for a 5-year term. If you get them a bit shorter, sometimes you get a significant discount to prime. And again, depending on what other products you have with the bank, let's say you've been a long-term customer of this specific bank, you might have a car loan, you might have some other lines of credit or something like that. And sometimes banks might say, you know what? This is a really good customer. He or she has a really good credit score. They have a decent income. They haven't had to sign up for any of the government subsidies, or they didn't have to sign up for any of the mortgage deferrals or anything like that. As a result, they seem like someone who is very much, in charge of their financial situation. So you'll probably qualify for a really good rate. And because you might have multiple products with the bank, they might say, well, you know what, we make enough money on the credit card this person is using on the various other loans this person is having with our current bank, and as a result, we're okay, giving them an extra low rate, an extra discount, right? So by simply having a look at this website here that I just showed you, right? So we can see, again, on different websites, if you go to different banks, there will be many other ones available. So I simply selected Montreal here, and for the 3-year variable, as you can see here, mortgage, the two that are listed are the 2.45%. So that's literally prime plus, minus 0.00, because that's literally prime, or 3.2% from Scotiabank here, which is prime plus 0.75. So that's not great, right? It's not, they're still very low rates, but I'm sure you might have seen some other special lower promotional rates. Now, strangely enough, usually the longer the term is, usually the higher the interest rate costs are. But right now, a 5-year term is actually less expensive than a 3-year term for a variable mortgage, all right? So now, obviously, this depends on what's going to happen also in the markets, and if the Bank of Canada decides to increase interest rates at some point or another, which they will have to at some point, but probably not for the next 2 to 3 years. Beyond that, probably it's anyone's guess when exactly and by how much they would increase it by or raise it by. But yeah, so right now you can get with a number of different companies roughly 1.5, 1.6, 1.7%. So and on this particular website, you can find this 5-year variable mortgage for basically 1.6% or 1.69% with HSBC, which is again prime minus 0.76 or prime minus 0.85% respectively. All right, and again, there's a bunch of different ones over here as well. Again, right now I just put them in ascending order from lowest to highest for your viewing pleasure, if you will. All right, there you go. All right, so for 3-year, the range is about between 2.45 and 3.2. For a 5-year is between 1.6 and 2.45, and for a so that's for a 5-year variable. For a 5-year fixed rate mortgage or fixed mortgage rate, that one would actually be fixed rates. And let's say for the 5-year, it's 1.69%. So the difference is 0.9%, which honestly is pretty much the same price. Like there's no real difference between a 5-year variable and a 5-year fixed at this point in time. And again, any person should make their own, do their own research and look at their own finances. If you think that rates will drop even further, then it might make sense to go variable. If you think that rates will be the same or higher in 5 years from now, it might make sense to lock in because, again, 1.69, 1.76% is pretty much the same as 1.6, 1.69 as we've seen before for the variable rates, right? So there's virtually no difference, with the added benefit that by locking in, you will know exactly how much you owe every single month, regardless of what happens with interest rates in the intervening years. So as a result, it's a lot easier to manage your cash flow. It's a lot less stressful in general. So it's usually a better idea for most people to go fixed if between fixed and variable, there's virtually no difference in price. Again, the only time it makes sense to remain with the variable one is if you're convinced that the Bank of Canada will have to lower rates below 0.25%, maybe lower it all the way back down to 0.0%, basically, because the economy is not doing great or what have you. So that would make it, but again, the difference is not that big, right? There's, historically speaking, long-term 5-year mortgages were around 6 to 7%, right? So having mortgages at sub 2% is ridiculously low. They're among the lowest they've ever been in history in Canada, right now. All right, so now, again, the main question for today is, all right, great. So a 5-year, right? As you can see, these are the ranges that this particular website showed me. Again, if you look around, you might find some 3-year or 2-year fixed term ones that are 1.5 or thereabouts. You might find even a smaller difference, or even the fixed rate to be slightly lower than the variable one. So again, there's virtually no difference here. So now the main question is, as today's title is, well, what's the difference really in price between a 10-year? Like, should you really lock in for 10 years? Because obviously if you lock in for 10 years, then again, you know specifically and exactly precisely how much you will be paying, not only for the next 60 months, but actually for the next 120 months, right? So that would be really, really nice. Well, it turns out, again, using the exact same website, that the 10-year fixed mortgages, again, according to them here, the lowest ones are about 2.6%, so 2.59% right here from Tangerine in this particular example. Again, depending on which province you live in. So let's say you're in Vancouver, so you're in BC, right? Okay, so in this case, let's see if there's any others. Okay, so no, the same one's available, but you see this Jerry Brar mortgages, that one did not exist if you had selected Montreal, for instance. So again, depending on which province you pick, you might end up with slightly more, slightly fewer options available to you. I'm going to go back to Montreal. There we go. Here we go. Okay. So those are the current mortgages. So then the question is, all right, so is it worth it to pay roughly, right? To pay roughly 1% more, 1% more between a 5-year variable and a 10-year fixed, or even a 5-year fixed, right? Because keep in mind, there's no real difference between these two, but there's definitely a 1% difference between these, right? So what does it really mean in terms of your cash flow? How much more would you have to pay if you lock in for 10 years, but have to pay a full percentage more? And how much how does that impact your cash flow, and how much would that also impact the size of the house you can get, right? Because a lot of times when you're applying for a mortgage, again, the banks are really supposed to look at how much house can you actually afford in terms of what is your income, what is your credit score, et cetera, et cetera, et cetera. And then obviously the longer you extend it, so the longer of an amortization you're getting, the lower your monthly payments are, therefore the larger the mortgage you can get. And the lower the interest rate is, the fewer interest payments that you have to make, and as a result, the lower your monthly cost is, and as a result, the more money you're able to borrow. If interest rates were 10% right now, you would only be able to borrow a fraction of the amount that you would qualify with the exact same credit score and the exact same income as you currently have, if interest rates were 10% versus sub 2%, basically. So how specifically does every single percentage or every single 0.5% increase or decrease in interest rates that you actually personally have to pay, how does that impact your monthly payments? That's what you want to know, right? That's how you make an informed decision. Well, let's just run the numbers, right? So in order to run the numbers, we're going to be using this subsection of the Rate Hub website. I'm going to just put this right here in the chat. You already have it. I believe it's the fourth link in the description of this video. I've already included it there. So here you go. So we can use, so this is what it looks like. All right. And we can basically use this to run a few examples. So here, if you want to just simply compare your actual mortgage, obviously, let's say you're buying a, $500,000 house. So $500,000 home here. And let's say, for simplicity's sake, let's just say you actually have 20% down. That way you don't have to worry about CMHC insurance. Okay, so I'm gonna, because you can run 4 scenarios at once. The initial idea is to run these 4 scenarios probably with the exact same mortgage rate that you're going to get, but the only difference would be, you know, would you have 5%, 10, 15, whatever percent here, you know, as a down payment. But let's in this case, let's just pretend we have this exact same setup. Obviously, you can use your own circumstances for this to make more sense. So we can then play around with different, so let's say we all select the 25-year rate amortization. And then we can basically select different mortgage rates and see how that impacts our calculation. So I've done that. So I'll also show you at the very end in 2-3 minutes how that runs. But basically here's already a table that I ran with some specific numbers. So I assumed here that you're getting a $100,000 mortgage that at 2%, right? So if you're getting a $100,000 mortgage at 2%, so with a 2% interest rate, and you're amortizing it over 25 years, your monthly payments would be $423.45 if you opt for monthly payments. That's basically what it would cost you. So obviously this is amortized over 25 years, but let's say you're getting a 2% mortgage that is fixed, then or variable, doesn't really matter, but like right now, this is how much you would have to pay every single month. So what happens if interest rates go up by 0.5%? Now, when interest rates will go up eventually, which again, most likely from what the Bank of Canada has indicated, what other central banks such as the Federal Reserve, as well as the European Central Bank have indicated, is probably not going to be for at least another 2 to 3 years. So interest rates will remain historically low as they are right now, or if there are any hikes, they'll be 0.25% or less than that. So it's really for next 2 years or so, most experts are not really expecting any significant or even insignificant hikes in mortgage rates. But what would happen if they would actually increase by 0.5% eventually, right? Well, your $423.45 payment would actually increase to $447.97. If it's an adjustable rate mortgage, this increase would literally happen the very next time your monthly payment is due, so basically next month. If it's a variable one, as I said, they'll try to extend the amortization. At the end of the day, by extending the amortization like this, you end up paying more for the exact same house because you're taking longer to pay off this debt, and as a result, you have to pay more interest back for it. If you're run out of the ability to extend it, because again, you're really close to the edge of this, then yeah, your monthly payments would actually increase in the same way that they increase for the adjustable rate mortgage, literally as soon as they're running out of the extension ability. And that might only happen either because you overextended yourself when it comes to how much house you bought for your abilities to pay it off, and especially if you just recently purchased a house, right? Because then there's no time to extend if you already purchased a house with a 25-year amortization and you just bought it a month ago. They can really only extend it by a month before they reach the 25-year max again. All right. So that's not a massive increase, right? That's just $24.52. So no big deal, right? So that's the increase there. And this represents 5.79%. So this is incredibly important to keep in mind, okay? People have the wrong notion that if interest rates increase by, let's say, 1%, then their monthly payments are just going to increase by 1%. Yes, your payment on an annualized basis in terms of how much you have to pay per year, yes, it goes from, let's say you're currently paying 1%, if it increases by, you're currently paying 2%, if it increases by a whole 1% within a certain number of years, you will have to pay eventually 3%. That is true. But that 1%, so in this case, that 0.5% increase is $24.52. That $24.52, if you're dividing it by the original sum, that represents 5.79% more in monthly expenses, right? So that's where it becomes an issue, right? So now, obviously, if you increase this by another 1%, so then you're by another 0.5, so a full 1% from the original 2%, you're going to 3%. Then your monthly costs are $473.25. Which represents a $25.28 increase from the previous 0.5% increase, but a total increase of $49.80. And again, this represents a 5.34% relative increase from the previous step, but represents a full 11.76% increase to your monthly costs from the original $423.45. Now, keep in mind, this is only for $100,000. In the vast majority of cases, in the vast majority of Canadian cities, people don't have only a mortgage of $100,000, especially if you just bought a house. Unless you're buying a house in the distant suburbs, or if you happen to be living in a significantly smaller town or village, for instance. If you're looking at house prices and even condo prices in most large metropolitan areas of cities in Canada, Toronto, Vancouver, Montreal, Ottawa, Calgary, etc., $100,000 doesn't really buy you anything anymore these days, right? So as a result, you would have to multiply this by obviously the actual number, right? So this could easily be, if you have a $400,000 mortgage, this 0.5% increase would be 4 times this $24 basically. So almost $100,000. So almost $100. Sorry. So that $100,000 times 4, if it's 400, that would end up being a $100 extra payment per month if it's 0.5% increase, and that would be roughly a $200 extra a month payment if it was a full 1% increase. And obviously, if it's a 0.25% increase, at that point in time, yes, for every 100,000, it's about $12.50 per month, which again doesn't sound like much, but how many people only have $100,000? Now, if you run this for the entire thing, you can basically see that if you were to increase interest rates, so if you believe that interest rates within 5 to 6 years from now will be closer to historic norms, not necessarily at the 6 to 7% or thereabouts, but let's say 7. Let's say you're expecting them to be around 4.5 to maybe 5% or so. So if they're 5% versus 2% right now, so that's a 3% increase. Again, this increase is not going to happen overnight, right? The first significant increase you're expecting is again 2 to 3 years from now, depending on what happens with everything else that's currently going on globally. But that would still represent this massive increase of basically $158 per month if you're making monthly payments per $100,000 of mortgage payments that you have. So imagine you have a $400,000 mortgage. This would basically be $624 more and 60 cents. So it would be $624.60 more per month if you have a $400,000 mortgage. If it increases from, again, 2% to 5%, okay? Which, again, it's not going to happen anytime soon, but within the next 10 years, it would not be, unexpected for interest rates to be much closer to the 5% range than to the 2% range they currently are at, right? So specifically here, if you want to really very briefly run the numbers, okay? So as I said, let's say you're buying a $500,000 house, you have $100,000 down. The reason I put that down, like 20% down, is just so we don't have to deal with any additional mortgage insurance payments. Obviously, if you only have 5% down, that's fine. If you don't mind paying the extra mortgage insurance, that's okay with the CMHC. Now, let's look at what are our current rates. So as I said, let's pick a 5-year fixed. So the lowest one is 1 point. Actually, you know what? Let's start with the variable ones, right? So variable, I'm going to pick the 5-year variable. So let's say this is 1.6. And for the second one, let's pick a fixed 5-year, 1.69 here. For this one, sorry. Okay, there we go. Sorry, I keep on pressing the wrong button. There we go. So let's pick a 10-year fixed. All right, so what's our lowest? I'd seen previously at 2.59%, right? Yeah, that's still 2.59. All right, so I'm going to include let's put this to, I'm going to put the custom 2.59 that I just saw earlier. I'm going to put that in here. And let's select here this one, okay? All right. So you can see that this is what happens this would be the current difference, right? So the current difference in cost, that full 1%, it's again about $200 more a month, right? $190, $92 specifically a month, between getting a variable at 1.6 or a fixed at 2.59%, right? So again, that's not nothing, right? But the question is, and this is purely speculation. No one, no matter how big of an expert or a novice they are, no one will be able to tell you with certainty when interest rates will go up, by how much they will go up, how quickly they will go up, and for how long they'll stay at those levels before they have to be dropped yet again. So if you believe that interest rates will be significantly higher 5, 6, 7 years from now, it might be worthwhile overpaying that extra $200 for next 2-3 years until rates start going up, and then underpaying for the remaining 7 years. Because again, keep in mind, the Bank of Canada does not set the fixed mortgage rates. The fixed mortgage rates are set by whatever the Canadian bonds are doing, with the same maturity as the term of the bond itself, so the Government of Canada bonds. Those are set by supply and demand in the market. If people think that the Canadian economy is robust, the Canadian government is handling things well, then there will be more demand for our bonds, because people want to lend money to a government that is seen as competent, and to a country that is seen as being prosperous, or at least not in significant decline. And as a result, you might actually see bond prices increasing quite a bit earlier than that 2 to 3 year range, where basically variable rate mortgages, yes, might stay low for the next 2 to 3 years, but bond yields might actually go up quite a bit earlier than that. How quickly will they go up? By summer to late 2021? Maybe. No one knows, okay? So that's kind of a guess. Now, obviously, the real cost, the real pain, if you will, would you choose to go with a 10-year fixed rate right now, is actually paying that extra $190 or so, $192 more a month for the next, at least few months, if not year, 2 years plus. So it's basically it's sort of it's speculation, but you have to again look at historically, for how long have rates stayed low? Why do you think rates will continue to be low for an extended period of time? Now, keep in mind, you can always convert a variable rate mortgage into a fixed one, but there are various costs associated with it. So please, 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 whatever you do, make sure you read the fine print of your specific mortgage contract. Different mortgages will have different stipulations about what are the associated fees if you want to switch from one type of mortgage to another. There might be significant penalties in some cases, way fewer in other cases, and so on and so forth. Now, the added benefit of getting a mortgage that is with a term that is longer than 5 years is that after 5 years and 1 day, all mortgages in Canada become open. What does that mean? It basically means after 5 years and 1 day, you can literally repay your entire mortgage, if that's a thing that you want to do, with the only penalty being charged to you 3 years worth of interest payments, and that's it. Whereas if you're getting a mortgage with a term less than 5 years long, you have to absolutely make sure that your specific mortgage is open by design, and typically those have significantly higher interest rates than the ones that are closed. That allows you to switch around the type of mortgage, or that allows you to switch around and maybe refinance or do anything like that, or port your mortgage from one house to another, and what have you. So make sure to read the fine print. Again, I'll cover this in a future session if you have missed my previous ones when I talked about this. So very quick wrap up here. So currently 5-year fixed rate mortgages or fixed mortgage rates cost virtually the same as your 5-year variable rate ones, right? They're pretty much the same. 0.09% is insignificant in the grand scheme of things. The 10-year fixed rate mortgage, that one, costs roughly 1% more. And that 1% translates to roughly $200 more a month if it's a $400,000 mortgage. So it's about $25 more per month per $100,000, basically, is the way you should be looking at it. Should you lock in a 10-year or not? Well, again, what should you consider? Well, again, run the numbers using this and see which scenario works out better for you. Is current cash flow more important, or potentially saving more money in the future? But again, I do say potentially. Okay, it's not a guarantee that interest rates will go up, significantly. It's just history being a indicator. There's not much lower that interest rates can go. It's more likely that they'll increase. Will they increase from the current 1.6 to 2% to 2.5 to 3%, or will they go up all the way to 4 or 5%? It's anyone's guess, really, right? So if what's important to you personally is to have available cash flow right now, then obviously opt for a variable rate mortgage. If you want a bit more stability and a bit more flexibility, and you're of the opinion that interest rates will likely be higher in 3-4 years from now, rather, and especially in 7, 8, 9 years from now, it might be worthwhile overpaying over the next 2 to 3 years. But again, it's speculation. Based on informed speculation, I would say, based on historical trends. Will those historical trends repeat or simply rhyme, as Mark Twain used to say? History will tell. So really, all it comes down to is really which option offers you the most flexibility and which option is right for you. So for some people, it might be right to get a 2-3 year variable rate mortgage right now because cash flow is really, really tight. You might have significant decreases in your hours because of COVID. You might be on various government subsidies or assistance, in which case you wouldn't be qualifying anyway for a mortgage to begin with. But you might be thinking of maybe renegotiating yours or trying to figure things out and change it, whichever way it may go. So those are things to consider, right? Is it important to have the cash flow, or would you rather potentially save some money in the long term? What's for sure is that if you go variable right now, you will currently save a little bit or significant amounts, depending on which one you're comparing it to, right? If you're comparing it to the 10-year, or if you're just comparing it to the 5-year fixed. And if you just want to have it fixed, but you don't want to overpay the extra 1% for the 10-year term, well, you can maybe consider getting just a 5-year fixed in that case in time, and at that point in time. So I hope this helps to answer the question. Should you and figure out help you to kind of run the numbers for yourself in your own specific situation. And that's really all that I wanted to say today. As I said, I'm trying to make these a bit shorter. And yeah, look out for new videos next week. I'm going to start publishing quite a few more. I've been working very hard on a number of them. It's just I wanted to accumulate a good repository of them before, because the next few weeks with the university restarting, everything else, I'm going to be restarting teaching, so it'll be quite busy. But yeah, so now that I managed to kind of have a few videos kind of backed up, that way, if I'm not able to do something, I'll be able to continuously post at least for a few weeks in a row, even if I don't have time to do those. So anyway, so I hope this was useful to you today. I'll post my posting schedule for Thursdays. I'll have it up by tomorrow. I'm still working on the schedule in terms of figuring out what topics would make more sense. So that should be posted by tomorrow. And then, watch out next week. I'll start posting short videos at long last. It's been like a month and a half I've been trying to get around to this. So thanks again, everyone, for attending, and have a great day. And perhaps I'll see you at in a future live stream or a future video. So all the best, and have a good one.